Welcome back to the deep dive. We're the ones who wade through, all the research, the articles, the notes, to pull out those really critical insights, the things that help you get genuinely informed. Today, we're taking a really profound plunge into the world of John C. Bogle, the legendary founder of Vanguard. And specifically, we're looking at his capstone work, Enough: True Memories of Money, Business, and Life. We've pulled together, well, quite a stack of sources, actually. Everything from biographical sketches of Bogle's life, detailed analyses of his investment thinking, and of course, a deep dive into the philosophy behind the book Enough itself. And our mission today, look, it isn't just about investment tips, although frankly, you'll probably walk away with some really powerful ones. It's more about uncovering the surprising origins of his quite revolutionary ideas, and maybe challenging ourselves and you two to really rethink what enough actually means, in our finances, but also in our lives more broadly. So get ready. This one might really make you reevaluate some things.
What's truly fascinating about John Bogle, I think, is that he wasn't just, another suit who made it big in finance. He was this giant in the industry, but at the same time, maybe paradoxically, he was one of his fiercest critics. Relentless, really. And from his earliest days, like way back, he had this knack for spotting the fundamental problems. Things like crazy high costs, murky practices, conflicts of interest. He saw all that long before he became, the John Bogle. And Enough, the book, it really captures that split, doesn't it? It mixes super practical, common sense investment ideas with this deep, almost philosophical look at what really matters. And for you listening, I mean, this couldn't be more relevant, right? We're all swimming in this world that's constantly telling us more, get more, accumulate more. It's complex. It can feel overwhelming. Bogle just offers this powerful counter-narrative, a way to maybe cut through all that noise and figure out what success looks like on your own terms.
Okay, so let's dig into where that unique perspective came from. Because Bogle's story, his personal life, it isn't just, color commentary. It's really the fire that forged his ideas. John Clifton Bogle, born 1929. I mean, talk about timing right. Right before the Great Depression just walloped America. His family, they were actually quite prominent, involved in founding American Can Company, but they lost pretty much everything in the crash that followed. And for him, this wasn't some abstract historical event. It was personal. Devastating. And then add his father's struggles with alcoholism, his parents splitting up. These weren't just footnotes. They were like formative experiences. They baked into him this deep sense of financial prudence, but also this really sharp awareness of the human cost, the real suffering that comes from wild speculation. He saw it destroy lives firsthand.
Yeah, absolutely. That kind of childhood, it doesn't just teach you about dollars and cents, right? It teaches you about, resilience and the hard edges of economic reality. It definitely seems to have left him with a deep skepticism about market hype, about euphoria, and this laser focus on protecting the little guy, the individual investor. Yeah. So when he gets to Princeton, working his way through scholarships, jobs, all that, he brought that perspective, that ingrained skepticism to his studies.
Which brings us to his senior thesis in '51. And honestly, this was a pretty bold move for a college kid. Instead of, rehashing standard economics stuff, he decided to look at this tiny kind of controversial corner of finance back then, mutual funds. His thesis, like 130 pages, the economic role of the investment company. It wasn't just homework. It feels more like, an act of intellectual rebellion. Because in it, he just systematically picks apart the industry's flaws as he saw them. Crazy high costs, big sales charges, and maybe the most damning thing, how active funds consistently failed to actually beat the market averages. He was pretty much sketching out his life's work right there, criticizing the very field he was about to jump into.
Right. And if you connect that to the big picture, like you said, it wasn't just some paper he filed away. That thesis, you could argue, was the founding document for his entire career. It really signaled, right from the get-go, that Bogle saw himself as a critic, a reformer, not someone looking to just fit in and climb the ladder.
Yeah.
So his career wasn't this slow dawning of ideas. It was more like, boom, executing on a mission he'd basically defined at age 22, this clear vision. And that kind of sharp thinking, that willingness to speak truth to power, well, that's what got him noticed by Walter L. Morgan, the founder of the Wellington Fund. Morgan hired him right out of Princeton. Imagine starting out like that, with this crystal clear view of what was wrong and needing fixing in your chosen profession. It wasn't about conforming, it's about changing the system.
But his time at Wellington Management Company, the firm itself, wow, that was dramatic, a real roller coaster. He shot up the ranks incredibly fast, became Walter Morgan's chosen successor, the heir apparent. He even convinced the firm, which was pretty conservative, to diversify beyond just its one main fund. Seemed smart at the time. By 1970, he's chairman of the Wellington Funds, but then Well, then came a decision he himself later called extremely unwise. A merger with another firm. He blamed it on immaturity and confidence, basically biting off more than they could chew. And when the market tanked hard in 73, the fallout from that merger really hurt the firm. And then, bam, January 24, 1974, he gets fired as CEO of Wellington Management Company, just like that. His career, by any normal standard, looked like it was in ruins.
And this is where the story just takes this incredible pivot. It really raises the question, doesn't it? How does getting fired, like spectacularly fired, become the most important catalyst in his whole journey? Seems like game over, end of a bright career. But no, this failure, this crisis, it actually forged his real purpose. And here's the key detail, the one people often miss. He was fired as CEO of Wellington Management Company, okay? And this is crucial, he remained chairman of the board of the Wellington Funds.
Ah, okay, so a split there.
A huge split. He still controlled the funds, the pools of money, but not the company charging them fees. That gave him this unique, frankly incredible leverage, and he used it. In March 74, just months after being fired, he proposes this radical new path, a report called The Future Structure of the Wellington Group. It laid out the vision for what became Vanguard. This new entity would only do administrative stuff for the funds, and here's the revolutionary part. It would be owned by the funds themselves, operating purely at cost.
So yeah, in this crazy twist, his biggest failure handed him the key to unlock his greatest success. It created the exact structure needed to eliminate the conflict of interest he'd been railing against since college.
Incredible, turning disaster into Vanguard. Which brings us to what Wall Street initially laughed at, right? Bogle's folly. The Vanguard experiment. He launches the Vanguard Group in 1974, picks the name deliberately, Admiral Nelson's flagship, signifying leadership, breaking new ground. And it's built on that radical mutual ownership idea. The shareholders own the funds own the management company. It wasn't just a legal tweak, it was the physical setup designed to kill that core conflict, where the manager's profits come straight out of the investors' pockets via fees. Bogle had this really profound insight, tying it all together. He said, strategy follows structure. Can you unpack that a bit? What did he mean, and how did that shape Vanguard? Yeah, that's a core Bogleism. What he meant was the way you organize a company, its fundamental structure, will inevitably dictate how it behaves and what products or services it offers. It sets the incentives. So, with Vanguard's unique setup owned by the funds, operating at cost, what's the natural strategic direction? It has to be cost efficiency, right? If making a profit for outside owners isn't the goal, then cutting expenses for the investor owners becomes the absolute top priority. And if you're ruthlessly focused on minimizing costs for investors, what's the ultimate low-cost strategy? Indexing, just owning the market. So in 1976, he launches the first index investment trust, later became the Vanguard 500 Index Fund. And the goal was stunningly simple. Don't try to beat the market, just be the market. Match the S&P 500's performance at the lowest possible cost.
Bogle's folly. I mean, it sounds like it landed with a thud initially. What exactly was so foolish about it to Wall Street back then, and why did Bogle stick with it when everyone was mocking him?
Oh, the reaction was brutal. Pure scorn, really. Bogle's folly. Yeah, un-American. Can you believe it? A guaranteed path to mediocrity. That's what they said. Why? Because it flew directly in the face of the entire active management industry's reason for being. Their whole catch was, we're smart. We can pick winners, pay us high fees for our expertise. An index fund basically said, nope, we can't reliably beat the market after costs, and neither can most of you, so let's just own the market cheaply. It was heresy. It threatened their whole business model.
Like admitting defeat.
Exactly. They framed as surrender. And the initial fund launch, well, it was a commercial flop, raised only about $11 million. Embarrassing by Wall Street standards. That just fueled the mockery. But Bogle didn't flinch. And this is key. His conviction wasn't based on marketing spin. It was rooted in simple arithmetic. He understood the tyranny of compounding costs, probably better than anyone alive. He knew mathematically that over the long haul, just capturing market returns minus minimal costs had outperformed most active funds' bleeding fees. His belief in the math, and frankly his sense of duty to investors, was just stronger than any ridicule.
It's amazing to think about that struggle now, because that folly, that ridiculed fund from 76, it's now, arguably the most successful investment strategy on the planet. The Vanguard 500 fund alone, from that tiny $11 million start, now manages, over $700 billion? It's just staggering. The triumph of indexing is the ultimate proof of Bogle's common sense revolution. And for you listening, that's a big reason why so many of us can invest today without getting gouged by fees. We get to keep more of our own money working for us. He fundamentally changed the game. And after Vanguard took off, Bogle didn't just, ride off into the sunset. He kind of took on this new role, almost self-appointed. The conscience of an industry became this tireless public voice for regular investors, constantly hammering the mutual fund industry for its high fees, its misleading ads, its frankly lack of accountability sometimes. His followers, even some competitors, started calling him Saint Jack. Kind of captured that almost evangelical zeal he had for the investors' cause, didn't it?
It really did.
And this commitment, it wasn't just finance. He served as chairman of the National Constitution Center, which kind of reflects his belief in those deeper foundational principles, democratic, ethical, that he felt were getting lost in the corporate shuffle.
So what does this all boil down to when you look at his own financial legacy? It's really striking, isn't it? When he passed away in 2019, his net worth was estimated at around $80 million. Now, obviously, that's a lot of money. But compared to other finance titans, guys who founded or ran much smaller, traditionally structured firms, they ended up with billions, plural. And this wasn't because Bogle was bad at business. Far from it. It was choice, a direct result of how he structured Vanguard, client-owned. The profits, instead of going into his pocket or to private partners, were plowed back to investors through lower costs. If he'd set it up like a typical Wall Street firm, he'd easily been a multi-billionaire. Instead, that wealth and estimates run over $1 trillion in fee savings since Vanguard started. That money went to Vanguard's investors, not him. That right there is the ultimate proof of his philosophy of enough. He didn't just talk the talk, he walked the walk. His life itself was the message. Stewardship over personal enrichment. That was his real measure of success.
That deep conviction, that sense of duty, it flows right into the heart of his investment philosophy. And it's so important to get this. Bogle's approach isn't just a grab bag of tips. It's a really coherent, powerful way of thinking, grounded in, inescapable math, rigorous logic, and this profound sense of responsibility to the investor. He wasn't about adding complexity. He was about stripping away all the costly, counterproductive layers, the speculation, the sales hype, to get down to the simple, common-sense truths underneath. Always investor first. You mentioned his philosophy is rooted in inescapable mathematics. What's the single most powerful, maybe even brutal mathematical truth he kept hammering home? The one that really changes how you should think about investing.
It's what he famously called the tyranny of compounding costs. Sounds a bit dramatic, maybe, but it's just a stark, undeniable reality. The equation is brutally simple. Your net return equals the gross return minus the costs. So basic, right? But somehow, it's been this silent killer of wealth for millions of ordinary investors. Bogle argued, relentlessly, that in long-term investing, you truly get what you don't pay for. We tend to fixate on the market's return, the gross number, but we often ignore how cost management fees, expense ratios, trading costs, taxes just chew away at that return. And they compound over time, just like the returns do. Bogle saw the financial industry in large part as this giant middleman, a croupier in his words, that effectively subtracts huge value from the economy by siphoning off returns before they reach the actual owners of businesses.
It's like a hidden tax, almost.
Exactly. A silent drain. You don't see it day to day, but over 30, 40, 50 years. It's devastating. He used these incredibly powerful examples to drive it home. Imagine you invest $1,000 for 50 years. Let's say the market gives you an 11% gross return annually, without any costs. That $1,000 grows to about $184,600. Impressive. Okay, now let's add a pretty typical, maybe even modest-sounding 2% annual fee, management fees, fund expenses, whatever. Your net return drops to 9%. That $184,600, it's now just $74,400.
Wow, less than half.
Less than half, just from a 2% fee. Now layer on, say, 1.5% per year for taxes on distributions or gains. Your net return falls again, maybe to 7.5%. Your final pot, just $37,000. So in that scenario, which isn't unrealistic at all, costs and taxes wiped out over 80% of the potential return. 80%. That, Bogle said, is the loser's game most investors unknowingly play.
So what stands out to you when you hear that? I mean, how often do we really sit down and calculate the impact of fees over decades?
Yeah, you don't. You see the percentage, 1% or 2%, and think that's small, but compounded.
That's enormous.
Exactly. So minimizing costs isn't just like a nice to have. Bogle insisted it's the single most critical factor an investor can actually control. Everything else, market returns, economic shifts, largely out of your hands, costs. You control those.
That example makes it crystal clear. And flowing right out of that focus on cost is Bogle's really sharp distinction, almost a moral line between investment and speculation. He thought these were fundamentally different beasts, and the industry blurring that line was causing huge harm. He defined investment as basically long-term ownership of actual businesses, focusing on their intrinsic value, their ability to grow, innovate, pay dividends over time. The return comes from the real economy generating wealth. That makes it, in his view, a winner's game overall because capitalism historically creates wealth. Speculation, though, that's different. It's short-term trading of, as he put it, pieces of paper, stocks, bonds, derivatives. The focus isn't value, it's just price movement. Speculators are betting on what someone else will pay soon. It's driven by emotion, hope, greed, not business fundamentals. Before costs, Bogle said, speculation is zero-sum. For every winner, there's a loser. But once the croupiers, the intermediaries, take their cut in fees and commissions, it becomes flat-out a loser's game for the players as a whole.
He saw the market shifting, didn't he?
Yeah, he watched with real alarm as it seemed to morph from a place to invest into this giant casino. He'd point to things like mutual fund turnover, how often managers buy and sell. It went from maybe 15% in the 50s to over 100% a year in the 2000s. Constant churning. That frenzy, plus the explosion of complex derivatives nobody really understood, just jacked up costs and risk. Wall Street loved it. Main Street paid the price.
It's true, though. Why do we as humans kind of gravitate towards that speculative buzz? We get bombarded, right? Hot stock tips, this fund manager is a genius. It taps into that desire for a quick win, the thrill of maybe beating the odds. But Bogle's point is stark. Chasing that thrill, that short-term gain, often means sacrificing long-term wealth because of those compounding costs. It's a real challenge to our natural impulses, isn't it? Demands patience in a world that wants everything now.
So, okay, if speculation's a loser's game, what did Bogle say was the winning strategy? And his answer was just radically simple. Broad diversification, and maybe most importantly, staying put. His famous line sums it up perfectly. Don't look for the needle in the haystack, just buy the haystack.
Yeah.
Instead of trying to be a hero, picking the winning stock or timing the market's dips and peaks, which he saw as speculation, basically feudal investors should just own the whole market, or a huge chunk of it super cheaply, and then just hold on. For decades, he boiled it down to some key principles for investors. Pretty straightforward, actually. First, pick low-cost funds. Always. He'd say that's paramount. Costs are the best predictor of your net return. Small fees become huge drags over time.
The math again.
Yeah, exactly. Second, think hard about advice costs. Make sure any advisor fees are actually worth it, providing real objective value, not just selling you something. Third, don't chase past performance. Yesterday's winners are often tomorrow's losers. Buying a hot fund usually means buying high. Bad strategy. Fourth, use past performance mainly to check consistency and risk. Did the fund stick to its knitting? Or did it just get lucky or take wild risks? Fifth, beware of star managers and funds that get too big. Stars often fade, and huge funds can struggle to maneuver effectively. Asset bloat, they call it. Sixth, don't own too many funds. Keep it simple. A couple of broad, diversified index funds beat a messy collection of niche funds almost every time. Easier to manage, too. And finally, maybe his most famous advice. Buy your portfolio and hold it. Just stay the course. Time in the market beats timing the market, which he thought was impossible anyway. Don't panic sell, don't chase rallies. Just hold on.
He did offer a simple rule for risk, too, right?
Yeah, the age in bonds rule of thumb, hold a percentage in bonds roughly equal to your age. So if you're 40, maybe 40% bonds, 60% stocks. Simple, adjust risk over time.
It's just elegant, isn't it? In a finance world obsessed with complexity, jargon, secret formulas, Bogle just cut through it all. He showed that the real power isn't in complexity, it's in radical simplicity. Discipline, low costs, patience. It's not just about better returns either. It's about freeing yourself from the anxiety, the constant noise, the feeling that you have to outsmart everyone. You don't. You just need to own the haystack and let compounding work its magic.
Now, to really grasp how revolutionary Bogle was, it helps to compare him to other giants like Warren Buffett and Benjamin Graham. At first glance, you think Bogle, passive indexing, and Buffett, active stock-picking legend, are polar opposites, right? But dig deeper, and there's this surprising alignment on core values. Buffett himself has been one of Bogle's biggest cheerleaders, calls him a hero, says he saved investors hundreds and hundreds of billions in fees. That's high praise from the Oracle of Omaha.
And Buffett put his money where his mouth was, literally.
Oh yeah, the famous bet. The $1 million wager, 2008 to 2017. Buffett bet that a simple, low-cost Vanguard S&P 500 index fund would crush a portfolio of 5 fancy funds of hedge funds picked by a top wealth manager. And crush it did! Buffett's index fund returned 126% over the 10 years. The sophisticated high-fee hedge funds averaged only 36%. Ouch! Big ouch. It was like a real-world lab experiment proving Bogle's point. High costs and active trading often destroy value, even for the supposed pros. And maybe the ultimate nod. Buffett's instructions for his wife's inheritance: put 90% in a low-cost S&P 500 index fund, 10% in short-term government bonds. That's about as profound an endorsement as you can get.
So what's the core difference then, if Buffett admires Bogle so much?
Well, the key philosophical split seems to be: Buffett believes a true expert, someone with incredible discipline, insight, and work ethic, basically, someone like him can beat the market consistently. Bogle, on the other hand, believed that while maybe theoretically possible for a tiny few, the odds are so stacked against everyone else and the costs are so high that trying to beat the market is a losing proposition for the vast, vast majority, professionals included. So for almost everyone, Bogle said, the rational thing is, don't even play that game, just buy the market.
Okay, that makes sense. What about Benjamin Graham, Buffett's mentor, the father of value investing? How does Bogle fit with him?
Graham's all about active analysis, right? Finding companies cheap relative to their intrinsic value seems different from indexing. But there are deep parallels in their temperament. Both preached discipline above all else. Both demanded rigorous analysis, even if Bogle's analysis led him to buy everything. Both warned against speculation. Graham's famous margin of safety, buying cheap to protect yourself, is about managing risk through price. Bogle achieved a margin of safety differently, through radical cost-cutting and maximum diversification, protection against individual company failure or manager error.
So both saw the market's craziness as a danger zone.
Exactly. They both saw emotional decision-making as the investor's worst enemy. Now, you mentioned Wall Street called indexing un-American and mediocre. Beyond just protecting their own fees, were there any legitimate intellectual criticisms of indexing that Bogle had to address? Any real downsides if everyone did it?
That's a fair question. And yeah, there have always been theoretical arguments. The most common one is the free rider problem. The argument goes, if everyone just buys index funds, who's doing the hard work of researching companies, figuring out what they're worth and setting prices? Active managers, theoretically, make markets efficient by doing that analysis. If everyone's passive, maybe markets become less efficient. Maybe capital doesn't flow to the best companies.
Okay, I can see that logic.
Bogle certainly acknowledged it. But his counter was usually twofold. First, he'd argue that a huge amount of active management isn't deep research anyway, it's just rapid trading, speculation, which doesn't help price discovery much. Second, he believed there would always be enough active players trying to find an edge to keep markets reasonably efficient. The potential for profit is too tempting. And for the individual investor, the guaranteed benefit of lower costs far outweighs that theoretical risk of market inefficiency creeping in. He also faced the mediocrity charge head-on. His response was simple. Maybe indexing is mediocre, but it guarantees you beat most active managers after you account for their fees, which is, statistically true.
So in a way, Bogle took Graham's skepticism about the market's day-to-day sanity and pushed it to its ultimate conclusion. If the market's often emotional, hard to predict, and efficiently priced overall, and if trying to beat it is so costly and failure-prone,
then the most rational, humble thing to do is just own it all, cheaply and efficiently.
Yeah. He distilled it down to that powerful common sense core, that profound simplicity, that conviction born from experience. It leads us right to his philosophical masterpiece, really. His book, Enough, True Measures of Money, Business, and Life, came out in 2008. Right in the middle of the global financial crisis meltdown. And this book, it's so much more than finance. It really goes beyond that, into this deep meditation on what makes a life well lived. Yes, it critiques the crisis, the financial industry's role in it, but its main aim isn't just analyzing market failures. It's this powerful call to rethink our values, personally and as a society. It's like moral philosophy wrapped in financial commentary.
And the heart of it, that central idea of what it means to have enough, is captured in that anecdote Bogle tells, the one he heard from Kurt Vonnegut. Vonnegut's at this fancy party hosted by some hedge fund billionaire, and he points out to his friend, the novelist Joseph Heller, that their host probably made more money that day than Heller's famous book, Catch-22, had earned in its entire existence.
Yeah.
And Heller's reply, it's just perfect. He says, yes, but I have something he will never have. Any guesses?
Enough.
Bingo. Enough. That story just frames the whole book. It becomes this inquiry into the sufficiency. Bogle uses it to challenge our modern obsession with, status, scorekeeping, the endless consuming chase for more.
Oh.
His goal, he said, borrowing from Vonnegut, was to poison our minds with a little humanity, to push us towards building true wealth which isn't just money rather than mere riches, and to recognize how greed and blind ambition can destroy not just values, but financial wealth too.
He kicks off Enough with 3 chapters really taking aim at money itself, or rather how we misuse and mismeasure it. Chapter 1, Too much cost, not enough value. This is classic Bogle, hammering that core point. The financial industry is like a giant casino dealer, taking a huge cut of the economy's productive output before investors ever see it. He uses some pretty stark data. By 2007, the financial sector, which doesn't really make anything tangible, accounted for a third of all S&P 500 earnings, up from just 6% about 25 years earlier.
That's a massive shift.
Huge. And Bogle argued that cost is basically deadweight loss, a drag on investors, a drag on the real economy. He also hits hard on how the industry puts its interests ahead of clients, eroding that trust, that fiduciary duty. Then, Chapter 2. Too much speculation, not enough investment. He expands on that key distinction we talked about. He's lamenting this shift from, making things, creating real value, to just trading pieces of paper, swapping assets back and forth while paying intermediaries a fortune. This hyperactive trading, the short-termism, he says that's the folly. It leads to higher taxes, adds crazy risks through derivatives no one understands, and causes those shocking market aberrations like the crisis itself. Hedge funds, high-frequency trading symptoms of this speculative fever, adding little real value. And Chapter 3. Too much complexity, not enough simplicity. Here he goes after Wall Street's love affair with complexity. He argues that they push complex products, the illusory rhinestones he calls them, not because they're better for you, but because they're opaque. Easier to hide fees, more ways for them to profit. He champions the real diamonds of simplicity, like the basic index fund as the smarter choice for almost everyone. He points to all those fad funds, remember the dot-com funds in the 90s, most blew up. That kind of innovation, he said, is often just marketing designed to extract more fees.
And these critiques, they aren't just abstract, are they? They hit you right where you live. Your wallet, your retirement plan, your peace of mind. When the industry prioritizes its own cut-through high costs, speculation, needless complexity, that means less money for your goals. College funds, retirement, whatever. Bogle was basically shouting, wake up, don't let them take your fair share. Understanding this helps you make simpler, smarter choices, protect your future, and keep more of the wealth the economy actually generates.
Then Bogle widens the lens. The next 4 chapters move beyond just finance to critique modern business culture as a whole. He felt it had lost its way, prioritizing numbers over, deeper values. Chapter 4. Too much counting, not enough trust. He goes right after that management mantra, if you can measure it, you can manage it. Calls it a trite bromide, even a hindrance to building great companies. His point. Our obsession with quantifiable stuff, quarterly earnings, short-term targets, makes us ignore the unmeasurable but vital things. Trust, character, integrity, kindness.
The soft stuff that's actually hard stuff.
Exactly, he warned. Numbers are not reality. At best, they are a pale reflection. At worst, they're a gross distortion. This altar of numbers undermines the real economy, he thought. Chapter 5. Too much business conduct, not enough professional conduct. Here he's mourning what he saw as this slow decay of true professions into just businesses. Fields like finance, law, even medicine, he argued, were increasingly ditching their core ethos, serving the client or patient above all for a commercial mindset focused purely on profit. He quotes Justice Brandeis defining a profession by its disinterested zeal for the public service. Bogle felt that zeal was vanishing. Which leads to Chapter 6. Too much salesmanship, not enough stewardship. A crucial difference for him. Salesmanship is transactional, short-term. Stewardship is about long-term trust, acting in the other's best interest. He argues finance, and much of business, chases the fool's gold of marketing and salesmanship instead of the real gold of trusteeship. Selling complex stuff not because it's best for the client, but because it pays higher commissions.
We've all seen that, haven't we?
Unfortunately, yes. And finally, for business, Chapter 7. Too much management, not enough leadership. This is a powerful one. He quotes the leadership guru, Warren Bennis. The manager administers, the leader innovates, the manager focuses on systems, the leader on people. The manager does things right, the leader does the right thing. Bogle pleads for real leadership vision, values, inspiring trust, not just managing processes and hitting quarterly numbers. Leaders build lasting value. Managers just maintain the status quo.
And the broader impact of all this. If trust and integrity get pushed aside for profits and metrics, it really corrodes our faith, doesn't it? Faith in institutions and leaders, even in each other. Creates cynicism. Bogle wasn't just talking about balance sheets here. He was warning about the fraying of our whole economic and social fabric. When business loses its ethical compass, society pays.
The final section of Enough, this is where it gets really philosophical. Bogle applies all these critiques to the biggest questions. Personal values, what makes a good life? He sounds almost like a secular preacher here, calling for a kind of spiritual reset. Chapter 8. Too much focus on things, not enough focus on commitment. a direct hit on materialism, consumerism. We focus too much on things, he writes, and not enough on the intangibles that make things worthwhile. Real fulfillment, he argues, doesn't come from buying stuff that fades. It comes from commitment to family, community, to work that feels like a calling, that has purpose, finding joy in service connection. Then, chapter 9, too many 21st century values, not enough 18th century values? A passionate plea for a return to Enlightenment values, the kind that shaped the U.S. founding. He holds up people like Benjamin Franklin. Praises that practical gospel of hard work, thrift, moderation, but combined with a deep commitment to community, the common good. He contrasts that with what he saw as our modern ethos. Instant gratification, pure self-interest, superficiality. He felt these were eroding the foundations of a virtuous society. A call for civic virtue, really.
Going back to basics.
Exactly. And the final chapter, chapter 10, too much success, not enough character. This really reviews his core. He says he never liked the word success, saw it as hollow if it wasn't built on character. True worth, he insists, isn't measured by your bank account or job title. It's measured by intangibles. Grace, kindness, integrity, devotion to others. Ultimately, he completely redefines success. It's not what you get for yourself, it's what you contribute, and the character you build doing it. Living by an inner scorecard, not just chasing external validation.
So what's the takeaway here for you listening? These last chapters, they're Bogle's big challenge. He's asking you to define what a good life looks like. Are you chasing stuff that leaves you empty? Or are you investing in commitments and character, things that offer real, lasting meaning? He's pushing us beyond just financial metrics to find true purpose, to define enough, not just in dollars, but in how we live.
John Bogle's Enough. It really is more than a book, isn't it? It feels like this moral, philosophical manifesto that's just as relevant today, maybe even more so. It gives you not just an investment strategy, but this durable framework for navigating modern life, for defining what's truly meaningful.
Absolutely. And that core idea, enough, it resonates so strongly with other philosophies, old and new. Stoicism. The parallels are really striking. Think about the Stoic focus.
Yeah.
Figure out what's in your control and what isn't. That's pure Bogle investment advice, right? You can't control the market, the economy, global events, but you can control your costs, your savings, your plan, and crucially, your own behavior, your discipline, your patience. That Boglehead mantra, stay the course, that's practically a Stoic virtue, keeping calm and rational when chaos swirls around you.
Don't react emotionally.
Exactly. And the Stoic view of wealth as a preferred indifferent. Nice to have, sure, but not essential for a good, virtuous life. That lines up perfectly with Bogle. Seneca, the Stoic philosopher who was, ironically, super wealthy, basically nailed it centuries ago. He asked, what's the proper limit to wealth? His answer, first, have what's necessary. Second, have what is enough. That endless chase for more. Both Seneca and Bogle saw it leads to anxiety, not happiness. And it connects to minimalism, too, the modern movement. Minimalism is all about rejecting that default consumer drive for more. Right? Choosing an intentional life focused on values, experiences, not just accumulating possessions. Bogle's critique of materialism, too much focus on things, and his love of simplicity. That's pure minimalist thinking. He wasn't saying live like a monk, but his life, his work, it all pointed to this idea. True wealth is having sufficient resources to live freely, purposefully, not drowning in clutter, financial or otherwise.
It's fascinating, yeah. How his financial advice taps into that deeper human craving for less noise, less overwhelm, more meaning. Things people are really searching for today with decluttering, digital detoxes, all that.
Yeah.
He really saw that societal fatigue early on.
He really did. And one of the most powerful data-backed arguments in Enough is his absolute takedown of runaway executive compensation. He called it a national disgrace. And his analysis is still a vital moral compass for judging modern capitalism. Bogle just meticulously dismantled the story that huge CEO paychecks were justified because they created shareholder wealth. He brought the receipts, the data. Between 1980 and 2004, CEO pay versus average worker pay exploded from 42 to 1 to 280 to 1. Adjusted for inflation, CEO pay grew like 8.5% a year, average worker pay 0.3%, barely keeping up.
Wow, the gap is stunning.
It is. And then he compared that pay explosion to actual corporate performance. Over that same period, overall corporate profits grew just 2.9% annually. That actually lagged the growth of the whole U.S. economy. So the idea that CEOs, as a group, were delivering value matching those massive pay hikes, Bogle showed the data just didn't support it. It was a myth, largely.
So what did he think was driving it then?
He blamed a breakdown in corporate governance, the agency problem, he called it. Corporate directors, who are supposed to represent the shareholders, the owners, were instead using other people's money, the company's money, to enrich the executives, and often themselves indirectly. And this was made possible because the real owners, the shareholders, especially big institutions, were often indifferent, more interested in short-term trading than long-term stewardship. They weren't minding the store. So Bogle's critique here, it's not just academic, it's a deep moral indictment, a system where the link between contribution and reward got completely severed, distorted incentives, eroded public trust.
That's a powerful case. But I can hear someone arguing, look, CEOs run huge companies, face massive risk, they deserve huge rewards. How would Bogle answer that common defense?
Yeah, it's the standard defense. He'd acknowledge the responsibility, absolutely, but he'd push back hard. First, he'd say those massive risks are often spread across shareholders, employees, the whole economy, but the rewards, highly concentrated at the very top. Second, he'd point right back to the data. CEO pay went stratospheric, but overall corporate performance often didn't keep pace. The link wasn't there. Third, he'd challenge the idea that these execs were uniquely indispensable supermen. Is the market for CEO talent really so perfect that it justifies these astronomical gaps? He doubted it. His point wasn't that CEOs shouldn't be well paid. It was about fair compensation versus excessive compensation driven by flawed incentives. When pay encourages short-term stock bumps over long-term health, when boards are basically rubber-stamping huge packages for their buddies, that crosses the line. It becomes mismanagement, pure and simple. Stewardship gets forgotten.
That fairness question, the impact, it's still a massive debate today, isn't it? His points remain incredibly relevant. You know, Bogle's legacy, when you step back, it's just monumental. It's Vanguard, now this global giant. It's making investing accessible and affordable for millions through index funds. It's the Bogleheads, that amazing online community keeping his principles alive. And it's quite literally trillions of dollars saved for ordinary people, thanks to his crusade for low cost. He got praise from Nobel winners, from Buffett, from countless advisors. A true giant.
And his work, especially enough, leaves us with pretty clear takeaways, doesn't it? Recommendations for navigating today's world. For investors, it's that powerful simplicity. Invest you must. Sitting on the sidelines not earning a return is actually the bigger risk long-term. Keep costs rock bottom. Fees are the enemy you can defeat. Diversify broadly. Don't gamble on needles, buy the haystack. And crucially, stay the course. Discipline, patience, tune out the noise. That's the key. For business leaders, he offered a blueprint for building something great, something lasting, based on values, not just extraction. His 10 rules are all about things like make caring the soul of your enterprise. People matter. Set the highest standards ethically, too. Culture drives results. Trust your people. Don't just manage by numbers. He called for leaders to be true stewards, focused on long-term value for everyone. Clients, employees, society, not just obsessed with the next quarter's earnings per share.
And that brings us to his ultimate challenge, doesn't it? The final recommendation. It's a call, really, to fundamentally change how we measure success. Look beyond the easy stuff, wealth, status, power. Instead, measure our lives by the strength of our character, the depth of our commitments to others. Bogle's own words here are just so inspiring. The great game of life is not about money. It is about doing your best to join the battle to build anew ourselves, our communities, our nation, and our world.
That, he taught us, is truly enough. #outro.
And with that powerful thought, we wrap up this deep dive into John C. Bogle's remarkable life, his revolutionary ideas, and his profound book, Enough. His wisdom really goes way beyond just dollars and cents, doesn't it? It's a guide for our portfolios, yes, but maybe even more so for finding purpose, for figuring out what truly has value. So as you go through your week, maybe take a moment, reflect on your own definition of enough, in your finances, sure, but also in your work, your relationships, your life overall. What does enough truly mean for you?
Yeah, and building on that final challenge from Bogle, think about how applying those core principles, sufficiency, low-cost commitment, not just financially, focusing on character, how could that simplify your journey? How could it enrich those parts of life you can't measure on a spreadsheet? Maybe pick one area, just one thing, inspired by Bogle. Where could you simplify or rethink your approach to find a little more enough starting today?
Something to think about. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment